There is a better way to invest than index funds. And no, I'm not going to be telling you some scammy way to invest, financial trash, or some untested promises. Everything I'm going to be telling you today is going to be entirely evidence-based. So what we're going to be going over is why this strategy is better than index funds, why it differs from an index fund strategy, the data behind why that happens, and finally, despite all this, why I don't think it's necessarily right for everyone. But first, to explain why this strategy is potentially better than index funds, I need to explain why index funds are so good. This comes down to the fact that stocks and securities prices reflect information. That means what you buy when you buy a stock is that you're buying the best possible estimate of what it's worth already. So when considering a price of a security, a simplified version is that in an efficient market, what it prices in is basically what you pay for a stock based on the expected future cash flows, as in earnings from the investment and dividends, and then that's divided by a discount rate. Growth companies will have a lower discount rates as investors generally are more willing to invest within them because of their growth potential. To the same extent, a value company, which is perhaps more risky in an unloved area, will have a higher discount rate because investors will be expected to be compensated to a higher degree for taking more risk. Now, that really is an absurd oversimplification, and I'm not here to try and go through technical finance theory. That's another video altogether. But hopefully that goes some way into explaining the dynamic of why you might pay less for every earnings of a value stock like, say, BP, which trades of a price to earnings of 11, than a growth stock like Nvidia at 72. Okay, so if that's how prices work, why do prices reflect information? Well, they don't perfectly to begin with. But the way to think about it is that securities can be bought and sold quite easily. It's kind of a hyper-competitive market where even the small advantage could create huge profits for institutional investors because they can access things like leverage and then take big bets on positions. And to give you the idea of the scale of what's going on, in 2022, the daily trading volume, as in per day, was $675.8 billion. That is a lot of trades that are going into those prices. So we can debate until the cows come home the extent that the market is efficient. And I don't think it's perfectly efficient. But let's just go over what would a generally efficient market look like. It would be one where those that do outperform wouldn't actually do so for very long. It would be really difficult to differentiate luck from skill. And guess what? That is a good summary of the markets. This graphic shows US domicile equity funds. And you'll see outperformance here. Now, the minute we zoom out to a time horizon which is relative to investors, you can see, well, one, a lot of funds get shut down, and that, by the way, is a huge sleight of hand of the fund management industry. And to be honest, it stinks as a practice, but it happens all the time. They just shut down the underperforming funds. So they start with lots of shiny fund options, and then they just shut down the ones that aren't performing, but then they'll produce the brochure with the survivors. Anyway, look, I digress. This isn't a rant about that. This is just that when you look at objective data, it's quite clear and consistent for most developed markets. The amount of these funds that survive is much lower than I think you'd like to see as an investor. Even for those that do survive, in the data, 27% were winners over 10 years, so slightly higher than 1 in 4 chance of outperforming. When we go to 20 years, that drops to 17%, and with that, only 44% of funds survived. So you might be thinking, okay, well, that efficient market, that just means great idea to invest in index, right? And just to buy into the market and set and forget. And my honest answer to that is you could do a whole lot worse, but there are alternatives that are worth considering. So with an index fund, you are essentially buying the market. And there is no such thing as a mythical market, because if you buy a total stock market fund, basically, which is based on the entire stock market, that still is market cap weighted. There really is no such thing as being entirely passive, because ultimately there are always decisions being made about exposure to certain markets. But the market is just one factor which can generate returns. And as kind of as a timely example, it's sort of like a football match. You know, if your aim is to score goals to win the game, which are like investment returns in this analogy, then the market is your striker. It's the most reliable, most likely to score. Think Harry Kane in Bundesliga, but sometimes your strikers will be out of form and they won't get any goals. Think Harry Kane for England. Anyway, when that happens, it can be really helpful to have a great winger or perhaps an excellent attacking mid. That is kind of a mixture of diversification of positions, which can make a big difference in certain environments. So what are these other positions and players? Well, there are lots, but the ones that are generally accepted across the board in academic finance are the value premium. So these are companies with a lower value compared to their cash flows versus growth. Size premium, which is smaller companies versus larger companies, with smaller companies being a factor which is expected to generate higher returns. The profitability premium, which is higher profitability companies versus lower profitability. And the thing is with applying factors, you can still do this in a way that allows you to choose investments that are diversified and generally low cost. So if I show you here, you can see the growth of $1 over a 10-year period in the US market. The blue line was small cap, which is the size premium. In the green, yellow is value premium. And finally, the very lowest, which basically went nowhere, is the market, or that was basically a good representation of the index of the US market. So you can see the diversification in different players there. Sounds amazing, right? Well, look, hold on there. If you do allocate to these premiums, they're not always positive. What this graph shows in the light blue is that's when value has outperformed growth, whereas in white is growth outperforming value. So while there was a value premium of 4.53% from 1928 to 2022 in the US market, returns at some points were like a ketchup bowl. Sometimes they'd come out all at once. Sometimes in from 2008 to 2022, you can see value heavily underperformed growth for a long time. People grew up over that time. And that is the thing. Having 1 year, if you do allocate to these premiums, is to be expected, which is why allocating to just one factor or one risk premium is probably not a good idea. This shows even when considering a 10-year rolling period from 1973 to 2022, there's still a 42% chance that if you allocate your strategy to one premium, it will be negative. When mixing premiums, though, there was a 0% chance when they were all considered together that it were negative. In fact, when we look over any meaningful time period across the different premiums and the market, you can firstly see the market versus bills, which is treasury bills, which is effectively a risk-free investment. Generally, the market, which is what an index fund will represent, has performed better than treasuries over a rolling 10-year period. This is exactly what we'd expect. Now, when we look at small cap, you can see that small cap premium has applied. It's generally outperformed large cap. But what might surprise you is that actually even happened in the early years after the great financial crisis, which has been a really big point for growth. So next, let's have a look at the value premium, which despite getting absolutely hammered from 2010, has actually outperformed most years versus growth. But again, in the last 10 years, it would have been negative. And then obviously finally high profitability here. This is why portfolios which do this well, if you want to consider a factor allocation, do have tilts and integrate a mixture of factors. Here you can see this versus the All Country World MSCI. Fund managers often use this as a guide of asset allocation, benchmarking the performance of global equity funds. This shows an estimated probability when you combine them together that there's a 90% chance they'd expect it to outperform over a 5-year period. So you're convinced? Are you ready to buy? Well, hold on. I said that while I'm convinced in the evidence and the effectiveness of these portfolios, I acknowledge these strategies might not be right for everyone. And why is that? Well, if you go and allocate to factors and you don't get the mix right, you could actually come off performing much worse than the market. What happens if you'd allocated to the value factor over the last 10, 20 years? How many investors are honestly really patient enough to hold on to the strategy to reap the long-term benefits, while hearing time and time again, the value premium is dead, it's a new era of tech, that, even for the most experienced investor, I think that would be incredibly tough. Seeing others get much better market returns over 5-10 year period. So for this reason, yes, factor investing is arguably better than index investing from a diversification and a potential returns point. But that doesn't necessarily mean it's the right type of investing for most people. If you have time and don't want stress, you could argue the market factor is broad-based index fund, which is the most robust factor overall, and will have allocation to some of these value factors also as well, just potentially not quite as wide and as integrated as a factor tilted strategy. I think it all comes down to what are you trying to optimize for? Are you wanting just a set and forget strategy or something more complicated? I always think it's sometimes worth taking a step back and going, okay, Do I have enough in investable assets that tweaking stuff around the edges is actually worth my time compared to if I invested it elsewhere, maybe earning some more money and then just adding that to my market-based portfolio? What do you think? Are you going to potentially consider using this for your retirement or your investing strategy? Let me know in the comments. Also, I've recently done a video on 7 big mistakes people make in retirement planning. There's a few interesting ones there. So if you are considering retirement, I'd suggest give that a watch. Thanks for watching.